everyone, welcome back to AWM Insights, where each week we cut through the noise of what Wall Street is selling you to bring you the knowledge, the skills, and access you need to invest like a pro. I'm your host, Eric Averill. I'm joined alongside my co-host, our Chief Investment Officer, Justin Dyer, and our Managing Partner, Brandon Averill. And this week, we want to jump into the topic about what are your expectations when it comes to market movements as an investor. We've obviously seen in this previous week the first really big down day of 2021, which is so wild to say. It was a temporary decline of only 1.7% in the S&P 500. And in that same week, we also saw the best daily return on Thursday that we had seen since July, and the markets, as we're recording this on Friday, look like they're going to end at least flat, and if not up. And so really, we want to make sure that we're setting what are the expectations of that investor experience when it comes to the movement of the markets. But before we do, as always, we're going to jump into some of the news across the markets.
Yeah, Eric, there's no shortage of what's going on out there. Reports came in today, some really awesome news, cool news to see that U.S. household net worths have actually surged to fresh records. So this is being fueled certainly by the growth in the equity markets, the stock market, and also the largest ever increase in the value of real estate holdings. So anybody that's out there trying to buy a house, I think can attest to that. But we saw the household net worth actually increase by 4.3%.
And you got to thank the Fed there too, right? They're priming that pump.
I know. On the one hand, we got the government helping grow wealth, right? And then we get Congress, throws a tax proposal out there as well. A lot of people are trying to decipher what's going on, but it looks like we're going to have higher rates, both on the individual side and the corporate side if things are passed for how they're drawing them up. But then also the bigger news, I think at least for our clients, is the elimination of many common tax minimization strategies. So they're trying to do away with the backdoor Roth IRAs. They're trying to do away with some of the transfer techniques and lowering the estate tax. So time will tell. Nothing's been decided. But that's definitely a big topic out there.
I think it's important there, Brandon, to note, this subject specifically is why this approach, the planning approach is so dynamic. You cannot just set it and forget it, whether it's your portfolio, whether it's your financial plan, whatever. I think it's really important to underscore that. I mean, the playing field is constantly changing.
Yeah, you have to stay on top of, how the tax laws are changing. Make sure your plan, like you mentioned, is dynamic. And then in other ways, right, you need to stay consistent, stay patient, stay in. And we saw the other big piece of news out there was Evergrande and China's debt problems. Certainly seems like they're not going away. I think a lot of people were reacting. We certainly got questions. How does all this China stuff impact my portfolio? But to your point, I think, as long as you have the plan, this is actually an area where you do stick with it and probably, hopefully aren't trading in and out, trying to read the tea leaves and predict the markets. We all know that doesn't work. So, but yeah, there's a lot going on out there. But I know we want to get back to the volatility of the week.
Yeah. And so why this topic is so important is what we talk about. We're trying to cut through the noise every single week of the financial media. And when markets opened on Monday, there had been this news about Evergrande and what's going on in China and in debt problems. And the news was relating this to the collapse of Lehman Brothers. And when you have no context, this should scare the living shit out of you, right? The problem is it's completely out of context. This has very little to do with you as in the investor and your investment experience or your financial structure and your priorities and the way that your customized investment plan should be set up. And so, rightfully so, we had some clients that were concerned, reach out and said, hey, the market, right? We saw it. We saw this day where it dropped 1.7%. Should we de-risk? Should we get out? And the reality is that's okay for a person who doesn't live within this world. But what we want to bring is some context that not only is this completely common, really what is uncommon is this unprecedented time of not seeing a lot more volatility to the downside in the public markets. We haven't seen a 5% pullback since October of 2020. And we'll get into some stats in a few minutes, but that is really the atypical investment experiences, is how just how positive markets have been. And then all of a sudden Thursday hits last week or yesterday as we're recording this, and we have our best day since July. And so really what we want to walk you through here is, what should you expect from the type of changes up and down in markets, and whether or not you should be making changes in your portfolio based off of these type of movements?
Yeah, and I think it's important to underscore, not only have markets just been marching upwards in a fairly persistent fashion, they've been incredibly calm doing so, right? There's two sides to that. I would add, and then Brandon, add to your thoughts, or add your thoughts to this, but what's happening in China and with the Evergrande's debt problems is expected. Not to say that specific event is expected, but when you're investing in the markets, you're putting your capital at risk, you're buying shares of companies, you expect there to be some unpredicted event, or some sort of event throughout and many events throughout your investing experience that are going to that will drive prices down, that even might bankrupt certain companies. That, I mean, go back to 2008, 2009, that really caused a shock to the whole financial system. But going back to my comment, and Brandon, thank you for underscoring that, you do need a dynamic plan in place, and you need to be able to adjust, but you need to do that within the long-term context of where your goals fit, right? You are long-term investors. Your goals and your priorities are over the long term. Reacting over the short term to a specific event, even significant events. I mean, let's go back to March of 2020, COVID. That was a significant event. The market corrected 20+% in some cases. And I mean, that probably made a lot of people feel uncomfortable, but we had a dynamic plan in place to react to that with the long term in mind. It wasn't, oh my goodness, COVID shutting down the economy, we're making a prediction, and the economy is going to stay suppressed for 6 to 18 months from now. Wait, we don't have that crystal ball, and no one does, right? No one knew that the Fed or Congress was going to step in with the stimulus that they did. I mean, people are now saying that this is the best reaction the government and the Fed has had to a crisis in history. Now, I think the jury's still out on that, but just to give you some context, most of the time the Fed reacts late, or Congress reacts late, or they, we're so partisan they can't even come to an agreement. Certainly, that's was kind of the case in the financial crisis. So you don't have that crystal ball. So trying to have a plan that is reacting to predicting the future it's a futile effort. And really, at the end of the day, not only is it a futile effort, it puts your situation at risk.
Yeah, and I would just add, I mean, it's healthy, right? We want markets to do this. When this news in China comes out, or we have the COVID correction, if you're a long-term investor, you want that to happen. We've talked about this time and time again, but markets reflect all available information. If they're immune to negative information, if everything continues to march higher all the time in the face of negative news such as this, there might be something wrong, and I think healthy markets are going to have volatility. It's why we invest. We take our capital. You get rewarded for putting it into the markets. We know over the long term, like we've talked about 9/11, 2008, the dot-com crash, through all those periods, right? Your investment still grows. Now you have to withstand that volatility, but that is healthy. It's healthy when markets go up and down. But it's hard. It's hard on investors. And I think we just have to really remember that we're in this for the long term. And when we have these momentary kind of, blips on the radar, and we see Bloomberg or Yahoo Finance or Fox News going absolutely, crazy around these events, we just have to remember that their entire job is to keep your eyeballs on their screen, not to grow your net worth, not to grow your portfolio.
Yeah. Yeah, and I think so. Providing context, right? A lot of our listeners here are either active professional athletes, retired athletes, or just fans in general. And what I thought about this is Brandon and I were at the Braves D-backs game the other day, and Freddie Freeman, as usual, hits a home run, has a double. Guys hitting over 300, hits a lot of home runs. He also punched out in that game. And what craziness would it be if after Freddie Freeman striking out, if everybody started panicking and was like, "Hey, Freddie, man, you got to change your swing. We're concerned here. I think we might take you out of the lineup." Like, that is laughable, right? Because what we understand when we are a player, or we understand the game of baseball, is strikeouts are a natural outcome of playing the game, right? It's this natural thing that is going to happen. So we don't panic. We don't pull somebody out of the lineup because over 600 at bats, he's going to hit 30 home runs, 40 home runs. He's going to hit 300. And it's not only are we not going to panic, this is a mainstay because we understand, based off of the evidence and the history of his performance, that he is going to lead to returns. It's the same thing when it comes to investing, is putting into context as an investor what we should expect. And so some of these stats that I thought would be helpful is going, if we're thinking about investing as a game, like the game of football or the game of baseball, we go, okay, what are these stats? Well, first, we're talking about, we haven't seen a 5% pullback, right, since October of 2020. Put it into this context. The average pullback that we can see in a calendar year is about negative 16%. There have been 53 double-digit drawdowns since 1928. So what we know of when we think of a typical correction as well, it's not negative 1.7% on Monday. It's really, we expect double digits that are going to happen really about every 4.5 years. That is the normal context of an investor's experience, is that, there have been, let's see, it's, the market has fallen 30% or worse 13 times, or one every 7 years. So once every 7 years, the typical investment experience is the market's temporary, and this is the key word, temporarily decline more than 30%. But what we do as investors is, the real differentiator, the real alpha, is called patience. It's understanding why you're investing, that as a long-term investor, this money that you have risked because you don't need it today, you have invested into companies that are using that to produce goods and services, and that over time, they're going to make money, and therefore you are going to be rewarded as an investor. You are not someone who's trying to panic based off of what happens on a daily basis. It's the money that you have given companies seeking profits from are matched to when you need to use that money.
Yeah, I think it's the corollary to your baseball analogy with Freddie Freeman is time in the market is way more powerful than timing the market. I mean, that's what we're talking about here. And you want to do that. You want that time in the market, and you want the approach to that to be systematic. Okay, what makes sense? What risk am I compensated for? We've talked about that. How can I get access to private markets? What should be my allocation to public markets? That should be very well structured, systematically put in place beforehand, and then you have some sort of rules and guardrails to react to times of stress. We go back to March of 2020, where we did some active tax loss harvesting when it made sense. We could actively rebalance and buy some more depressed assets with assets that were potentially maintaining the value, right? These are all things that are put in place ahead of time, and the logic of them is very, very sound. It's either academically based or based in some sort of economic logic, which you touched on, Eric, where these are companies that are selling products to consumers. That demand is somewhat always there, right? Consumer demand does fluctuate, but there's this economic driver that then supports markets and the valuation of markets to come back from times of correction. And again, build wealth, compound over the long term, compound over multi generations, and really maximize your net worth.
Yeah, well, one of the things that you mentioned, right? Like, this is not easy. So even if I have context, and we see this, right, with in sports, the general manager or the coach that panics, and everybody's like, "Dude, give it a rest. Like, allow your players to play. Allow them to go through a slump." Because it's going to come out the other side. But a lot of times it's the emotion is people, and we know this. We as humans are the biggest risk to our investment success. And it's because it's why when we say, hey, you should sell high and buy low, that's an easy bumper sticker or investment mandate, insanely difficult to do. And the reason is we're prone to panic when we think, when we predict, when we try to believe that things are going to go south. And there's two, what we would call behavioral psychology things that are at play. The first is loss aversion. In their seminal work, Daniel Kahneman in Thinking Fast and Slow talks about this, that it is far more painful when we lose money than we have the same type of gain, right? Like if I gain $100, like I'm excited, but if I lose $100, man, that hurts. And so there's this emotion at play that says, when I see declines in my portfolio, that hurts far more than when I see gains. And therefore, I'm more at risk to make bad decisions. And that's why we're trying to put things into context to say, hey, this is temporary. This is normal. Don't allow our emotions to dictate our decisions. Let's go back to the investment plan that we put on paper using all of the academic evidence and research that says this is what leads to higher returns, that we put this plan together when things were rational. So that's what we go to. We go back to the playbook. We don't allow our emotions to make our decisions. And then the second one, it's herd mentality. We know this. You don't want to be the person that on the upside gets left out, right? That's called fear of missing out, FOMO. But it's also on the downside. You're like, wait a second, everybody else on Twitter, everybody else on TikTok, everybody else on Reddit, right? And in the news is saying the markets are going lower. This is it. It's going to crash. And you're like, well, I don't want to be the one who's sitting by myself. And so you follow the herd. Here's the thing. Both of those are amateur moves. Every amateur investor allows their emotions to dictate their investment decisions. Professionals, pros, we go back to our playbook.
Yeah, and the behavioral side of it, I think it's very important to underscore. You can't eliminate some of those reactions. What is important is to acknowledge them. Acknowledge them, pick up the phone, talk with your advisor, talk with us, ask us questions, and let's talk through it and go back to the playbook, like Eric said, right? You cannot, we're humans. You can only do so much to, get your brain to cooperate in some situations, but acknowledging that exists and you can't necessarily overcome the feeling. You can overcome the reaction by going back to your plan, going back to the playbook, sticking with it, acknowledging your priorities, et cetera, et cetera.
Yeah, I would just add to that, and I'm glad you brought it up, Justin, but it is rely on your advisors, because that's a big part of why you have them in your corner. They're giving you the advice. Their job, hopefully, is to help keep you in your seat and aligned with that playbook, that plan that you've put together. There's a reason why I think it's the Dalbar study. Every year, they put a significant value on the advisor's ability to help you through these events. It adds to your return significantly over time. So just I think it was a fantastic point.
There's also, last point I'll make, there's a study Schwab cites, I can't think of the name of it right now, but basically an organization went through a big, pretty in-depth study and said, okay, people who have a financial plan, who stick to their financial plan, end up having 2.5 times greater net worth than someone who did not. I mean, that's incredibly powerful right there. I mean, 2.5x just by sticking to your plan. Like, I mean, sign me up, right?
So one thing I want to park on real quick is about the advisor, right? Or where we're getting our advice from. We see this. Let's take it out of the personal situation first and go to like the medical situation, right? In the middle of COVID, right? What we should acknowledge is if I'm on Google, and I'm not saying to not do your research, right? But if I'm on Google real quick and I read something, that does not equate me to being an infectious disease expert, right? Like there's a difference because I read an article or I did some research or I listened to a podcast by Dr. Peter Attia, who I respect like crazy. I do not have the same skill set, experience, knowledge, expertise that an infectious disease doctor does. And therefore, I shouldn't understand the medical decisions that are going on at that level. And I think, unfortunately, going back to the financial media, right? Like, because they want to extract money out of your pocket, or Wall Street wants to, right? There's this famous book that says, like, where are all the customers' yachts? Meaning, Wall Street, they're the ones up in Rhode Island. They're the ones, the Goldman Sachses of the world, that are driving nice cars and have yachts because they're extracting dollars out of your investor pockets because they want to sell you something. They want to sell you news, right? They're not in your best interest. And so if that's where you're getting your advice from, you just got to recognize, hey, there's a conflict there. They don't know me. They don't care about me. And then as an investor, you're not supposed to know all this stuff. So don't feel bad. You know, I know I was this way when I first had a signing bonus, and I would feel insecure, like I should know what's going on in the public stock market. That's crazy, right? So I essentially want to let you off the hook as the investor that says, you know what? I don't have to follow the herd mentality. I don't have to have the anxiety of trying to stay up with the news. That's why you hire an expert. It's why you hire advisors that have no conflicts of interest, that have no products to sell you, and that have these designations, right? Like Justin, the CFA, he wakes up Monday through Friday, at least 40 hours a week, and thinks about what is the best, most rigorous, academic, evidence-based way to invest your money as a client. And if you're not waking up and you're not putting that amount of time in and you haven't put the expertise in, you shouldn't expect to be successful when it comes to making investment decisions.
Yeah, and I think, Eric, you should wrap it up. We've gone long, but one quick plug is there's a fantastic book out there, kind of longtime advisor, Steve Lokshin, and it's called Get Wise to Your Advisor. Highly recommend it on this topic. If anybody wants to reach out, we're happy to get you a copy if you reach out. So we'll throw that out there.
Yeah, and I just want to end on this note, and I'm not going to take credit for it. The majority of this came from an incredible blog that we've talked a lot about on this podcast, A Wealth of Common Sense, and it goes back to this market timing situation, and really, it's helping us understand that even if you think that you can predict, the movements of one individual company, it's just not that, right? You would have to be able to predict every single geopolitical, every macro and fundamental story ahead of time to figure out where the investment world's going. And not only predict what happens, but here's the hardest thing. You would have to predict what human beings, who we just talked about are irrational, how they would invest based off of these events that they could predict. And I think if we're all being real honest, that's insanely difficult to do. But here's the good news, right? As we've laid out, if you work with your advisor who knows your priorities and develops a customized investment plan for the long term, your patience will be a differentiator and you will outperform the masses and most importantly, be able to achieve your priorities. And so make sure you head over to awminsights.com. We'll link everything in the show notes. And until next time, own your wealth, make an impact, and always be a pro. The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.